The stock market today, you think you're diversified if you have an index fund. It's not diversified.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larsen. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's show, I'm pleased to have Bob Fraser. Bob is CFO and Chief Macro Strategist for Aspen Funds, a fund sponsor in multiple asset classes, including private credit, commercial real estate, distressed debt, energy, and others. Aspen focuses on data-driven investing, identifying top macro trends, then constructing opportunistic investment funds. Bob is known for his data-driven and paradigm-shifting lectures and is co-host of Aspen's Invest Like a Billionaire podcast. And today, Bob's going to share some of what you will learn in his new book by the same name, Invest Like a Billionaire. Bob is former magna cum laude, UC Berkeley computer scientist. He's a tech startup founder that he's going to talk about today, as well as an Ernst & Young Entrepreneur of the Year award winner. He's been happily married for 40 years and has 4 amazing grown children, and I'm proud to say that I am friends with some of them. Stay tuned and learn how to invest like a billionaire on today's podcast. Bob, welcome to the show.
Yeah, so good to be here. Looking forward to it.
Yeah, man, I'm excited. I got to know you. I've known your son for several years and some of the members of your team, but I got to see you speak a couple years ago. And, you're one of the people that I look and I say, wow, like he thinks the same way I do, but you've got a few more years of experience than I do. And I really enjoyed hearing you talk about the way you view things from an investment perspective and the framework that you bring to your business, Bob. And I'm excited to have you share some of that with the audience today.
Yeah, all the mileage of old age can, I guess, have some dividends.
Hey, if you apply it correctly, right? But we're really excited because you guys just came out with a new book, Invest Like a Billionaire. And one of the things that we really try to do here at Next Level Income is to help educate people not only on the pathways to making more money and keeping more of that money, but really how to invest like the ultra wealthy. And I often say like, hey, this is how the families that are worth $20, $30 million, $100 million invest. You've taken it a step further and said, hey, these are how billionaires invest, and you help your investors do that. Before we dive into what listeners will see in your book and some of the lessons you've learned, Bob, you mind sharing a little bit about your story and what you do at Aspen Funds?
Yeah, sure. Well, I got started as a computer programmer, so I was a very happy coder in my little cave, and loved that. Started a .com in the 90s and raised $44 million in venture capital, ended up with 300 some employees. The thing was an absolute rocket ship, and then lost everything in the .com crash. And then became a professional stock market trader after that, lost everything again in the great financial crisis.
Oh my goodness.
And so after that, I became kind of allergic to the public markets, right? I mean, it's like I wanted something that wasn't narrative driven and volatile. I wanted something that I could control, right? So an apartment complex, right? When the stock market crashed is, 25%, how many people stopped paying their rent? Not that many, and so that's what I wanted, is something that's more control, levers and buttons that I could push, that I could be in control rather than have some outside forces dictate my life. And that's what, private alts started Aspen Funds shortly thereafter in the aftermath of the great financial crisis. I had found my partner who was a master in distressed debt, and there was a lot of distressed debt, figured out how to buy debt on the cheap and make money on it. And he was the genius that figured out how to do that. And I was the Mr. Scale guy, and we started Aspen, and it's been, steady growth ever since.
Yeah, it is amazing how many people I've had on the podcast that tell similar stories. And, I lived it a little bit. I was investing in the stock market in the 90s while I was in college trading, and just watched, I was making $1,000 a week, and then, make it, lose it, make it, lose it. And I was like, I'm laying there 3 a.m.
Like
in
Vegas,
the morning.
man.
Oh, it was like Vegas. And I thought I was an investor, and I'm laying there at 3 a.m. one morning, Bob. I'm 20 years old, and I'm thinking to myself, and I literally got up and I drank like a Red Bull, And this thought went through my head and it said, I'm going to be dead by 40 if I do this for 20 years. And I'm like, this
Yeah.
is not investing,
No.
which led me to real estate.
Right.
And it's one of those things when you get smacked upside the head, and we just saw a big liquidation in the markets and the crypto markets. And my young 13-year-old son was saying, Dad, like I want to learn how to day trade, and I'm learning from this guy online. I go, well, how much experience does he have?
Oh
And
my
he
gosh.
goes, oh, he's 20. He's got a lot of experience. And I laughed and I
Oh
said,
my
Miles,
God.
I love it. Keep learning that. I said, but let me teach you, what we do and how we built wealth in real estate. And I hope I hope he learns that and sees that, because I think there's some entertainment to be had. And there's money to be made in the
Those
market.
are such great conversations,
Yeah,
because we all started out where Miles starts out, right? You're
yeah,
optimistic and it
absolutely.
all looks great. You believe everything you
Yeah,
hear, and then you get to be my age and you've kind of been around the block many times. I mean, I've been
yeah,
through four freaking cycles, dude.
yes.
I'm ready for the next one.
Yes. Yeah, and I know, and I respect how you guys have positioned. So, Bob, I know you built, the core of your business on buying, just would you call it distressed debt and
Yes.
like kind of rehabbing notes,
Yes. Right.
which we did, 10, 15 years ago. It was great. You could buy stuff 10, 20 cents on the dollar. It was
Yeah,
amazing.
exactly.
But you've evolved since then, and I love how you've had a real foundation on the macroeconomic
Right. Yeah,
indicators on there.
we always knew we weren't the distressed debt guys. We were the alts investor guys, right? And
Yeah.
so distressed debt just simply was the stage one of the rocket that
Yeah.
got us into orbit. It's high margin business. It's very
Yeah.
good business, but we always knew it was short term, right? It was a season of that where that stuff was available. But we knew there was great opportunities elsewhere, and when we had a very diverse team. So,
Yeah.
Ben is a banker and really understands the, debt and
Yeah.
structure. Another one of our partners is industrial developer, very
Yeah.
huge experience there. And another one is just real estate. And so we kind of started branching into these other areas really based on data. So,
Yeah.
my research, so what happened is after I lost everything twice,
Mm.
I became, I don't know, obsessed with understanding the economic forces at work. And today I still read 2 to 4 hours a day
Yeah.
of just ingesting massive amounts of information. And I'm a speed reader. So I just eat and I like to understand where things are headed. So I'm not blindsided.
Yeah.
And I started making a lot of calls and they started being right. And so based on data, then we started selecting where we want to place capital and the
Yeah.
strategies.
Yeah. So would you share a little bit about some of the segments? I'm familiar with it, but our audience may not be. So where has Aspen Funds expanded here over the last 5 or 10 years outside of the
Yeah.
note
So
business?
yeah, started out in notes, but quickly went into multifamily several years back when that was really accelerating. We got into energy.
Hmm.
People do not realize what has happened in the energy sector.
Yeah.
That producing energy assets, I mean, producing oil fields. So
Yeah.
there's no drilling risk, there's no geology risk, there's commodity price risk. That's all. And
Yeah.
these things the prices have dropped 60 to 75% from pre-great financial prices for the same oil field. And
Wow.
it's a generational buying opportunity. People do not realize how much cash is being generated there. And so we branched into that based on the reshoring trend, companies moving back to America, nearshoring, reshoring,
Yeah.
realized that one of the best ways to play it would be industrial real estate.
Hmm.
And we discovered it's very difficult to buy good real estate, good industrial, but to build it is they're very simple and there's a lot of it just they works. We make a lot of money doing it.
Yeah.
So we started building a massive industrial pipeline. And then because of our debt creds and our credit creds,
Yeah.
we just love debt. And so
Yeah.
we started a couple credit funds that are
Hmm.
pretty large and operate those today. And credit is one of these areas that investors don't pay enough attention to. I
Yeah.
find the more sophisticated an investor is, the more they like debt. I mean,
Yes.
we're getting in our credit funds, we're getting equity-like returns, but taking a tiny fraction of the risk. And one of the points I make in my book, and people don't do the math, they don't realize this, but losses are far more important than gains in your
Yes.
portfolio.
Yeah.
And mathematically, that so minimizing losses is way more impactful to your wealth than maximizing gains.
Yeah.
And this is what the billionaires know. And
Yes.
so anyhow, so credit just fits. So those are some of the categories that we pay attention to and
Yeah, I
focus
love
on.
it, and that's a great transition. And love the private credit space. We partnered together, as you know, with our private credit fund with you all, and yeah, it's a great space, and I agree with you in that the more sophisticated investors understand, that they can move down in the capital stack to a lower volatility, a lower risk position,
Exactly.
and capture the majority of the returns, which is a real
Exactly.
sweet spot in there. But you said, hey, this is what the billionaires do. So Bob, tell us, like, why did you decide to write this book?
I am so excited about this book, and I found most investors, have not gotten into alts, are still in the public markets and just subject to this incredible volatility of the public markets. And then I find the people that have dabbled in alts are very undisciplined, and they don't understand what they're doing. They don't understand how to do what they're doing. It's more willy-nilly. And
Mhm.
I put myself in that category. As I wrote the book, and I'm organizing all my thoughts and putting it all together really for the first time. I mean, it's a lot of data that I knew a lot of things,
Yeah.
but I pulled it all together, and when I actually applied it to my own life, I realized, holy smokes, I have made every mistake you can make. And it's just by just taking the deals as they come, by just doing random investments, I realized I really have completely misallocated, and I've taken shortcuts. I've not done it right. And a disciplined approach that's based on science and mathematics is the way to go.
Yes.
To treat your investments as a business, and
Yeah.
you are a professional investor, whether you're managing 100 grand or 100 million, right? You
Hmm.
should treat it the same. And so that's why I wrote the book, just to educate people on how to portfolio them, how these alt classes work, what their superpowers are, the math behind how to construct portfolios, how to put everything together, and structuring, due diligence, taxes, the whole thing, how to do this in a professional way.
Yeah. Now, I'm sure some listeners are hearing you, Bob, and saying, "Okay, yeah, I've got 100,000. Like, I can't invest like a big family office that has a team that's evaluating all these things." What are some things that investors that are getting started in the alt space, have been in it for a few years? I love what you say. Let's maybe take it from the top down. Like, how do billionaires invest differently than your average retail investor that says, hey, I'm in my 401k, I've got a 60/40 stock bond portfolio?
Yeah. Well, several things, but the most important one is they're 20 to 30% in in the stock market
Mhm.
and 50 to 60% in private alternatives. So if
Yes.
the stock market takes a dump,
Yeah.
they don't wake up in panic the next morning going, "Oh my God, am I going to have a future?"
Yeah.
So and so what happens is, so the stock market today, you think you're diversified if you have an index fund.
Yeah.
It's not diversified. 30 a third of the S&P 500 is 10 the top 10 companies.
Yeah. Yeah.
You're buying 10 companies if you buy an
Yeah.
index fund. And by the
Yeah.
way, what's happened, especially since the great financial crisis, and I have a chart in the book that shows this,
Yes.
correlations have all gone to one,
Yep.
meaning every stock moves the same as every other stock. You ever notice when you have a red day, everything is red? It doesn't matter, that
Yeah.
if Amazon dumps its numbers, why do REITs sell off? But they do.
Yeah.
And that's the problem. that you can't get diversification. And so what happens is if you do this thing called you get uncorrelated returns with things that are uncorrelated. The only way to do that is private alts.
Yes.
You end up with higher returns and or less risk. You can really choose to take less risk for the same level of returns or get higher returns at the same level of risk.
Yeah.
And this is what David Swensen, who pioneered this whole model that
Yeah.
revolutionized what the billionaires do, called the free lunch
Yeah.
in
Yeah.
investing.
Or Ray Dalio. Yeah. And Ray Dalio calls it the Holy Grail. It's like, how do you allocate so you decrease risk but increase returns? And that's
Right.
exactly what he talks about. Yeah. So just to underscore that, if you look at the Tiger 21 survey, which has you have to minimum net worth is $20 million in that group. And if you look at their survey that comes out every quarter that I get, it shows the same thing that you're talking about, Bob.
Exactly.
Yes,
They all follow this pattern. They
they
all
do.
follow this
Yeah.
pattern, Chris.
Yeah.
And in 1985, when Swensen took over the Yale endowment, all of the billionaires were in stocks and bonds 60/40.
Yeah.
And they've completely changed. You can earn much higher return with much less risk by simply having an alts portfolio. But as many investors have learned through the multifamily meltdown, right?
Yeah.
It's not as simple as just finding a sponsor and throwing capital at it,
Right.
right? You want to do your due diligence. You want a portfolio, allocate properly in different, across sectors, asset classes, and you certainly want to do your due diligence and select your sponsors very carefully. And I go through all that in the book as well, how to do
Yes,
those
sir.
things.
Yeah. Yeah. So as you mentioned, asset allocation is something that the billionaires do differently. Something that you also mentioned, and Robert Kiyosaki says this when I read his book shortly after I bought that first piece of real estate in college. He said, you want to be an investor as quickly as possible. And what we talk about here at Next Level Income, we say, think like an investor. And that's how, as you mentioned, Bob, billionaires say, we treat our investments like a business that's out there,
Yes.
not like that. So talk a little bit about how billionaires and family offices treat their investments more like a business versus just throwing them in a ETF, for instance.
Yeah, well, and yeah, imagine you suddenly got a big inheritance and you're like, okay, well, what do I do? Well, then
Yeah.
you're going to start to get advice. You're going to start to think about, well, where do I put the money? What kind
Yeah.
of, how do I want to think about the categories I'm investing in? How do I want to manage risk? And
Yeah.
and it's really a mindset to be a business owner, right? If you're a business owner, you're thinking, how do I run this business? And most investors don't think of themselves as running an investment business. They think of themselves as making some investments. So that
Yeah.
it's a key mindset shift is
Yes.
is think about this and you know create a hub LLC that is your investment business, which by the way then can qualify mostly usually for a solo 401k,
Yeah.
all your get the tax benefits of running a business and it's your investment business and
Yeah.
go to conferences, learn things, go to join masterminds, listen to great podcasts and these things. Read books, right? Read
Yeah.
good books.
Yeah. And run that expense through your business, right?
Exactly.
Yeah.
Exactly.
Yeah, no, I love that. And again, that is something that's fundamentally different. Most billionaires got that way because they had a business and they take that same mindset and they treat their investment portfolio like a business and do that.
Right.
There's some simple steps, as you mentioned, Bob, from a legal structure perspective. You can do that. You can set up, very simple things. You can set up a separate bank account. You can run that separate P&L for that business and take a
Right.
look at that. The other thing that you talk about, and you talk about this in your educational content that's around the private credit fund, you talk about how billionaires don't just allocate differently in asset classes, and we touched on this a little bit with private credit, but they also allocate differently in the credit stack. How does private credit, fixed debt fit into that asset allocation?
Yeah, and we actually have a kind of a paradigm that we've put forth in the book. We call it the alternative investment continuum. And so it's how to approach this in a gradual fashion. So a lot of people aren't just going to go immediately start buying hedge funds, right? And these things. So you start with private real estate,
Hmm.
then you go to private credit, then you go to, natural resources, and so you kind of go up the sophistication chain. The more capital you have to allocate, the more you allocate to these other areas. So just to hit on the first one, private real estate. Well, each one of these asset classes has superpowers. Okay.
Yes.
And so private real estate has some of the best tax benefits of any asset class.
Hmm.
It's one of its other main superpowers is inflation protection. So when you buy real estate, that real estate appreciates with inflation. But what you may not think about is if you're levered, which all real estate pretty much is, and you're levered to one, which is generally what you do, you're getting a 3-to-1 lever on inflation. And if you're borrowing money to lever,
Hmm.
which you are, you're paying that debt off in dollars that are decreasing in value. So you have this
Yeah.
triple lever on inflation. So if you hate inflation, if you don't like paying more in the grocery store, well, get on the other side of it, right? You
Yeah.
don't like pumping gas, you don't like what's your gas price, well, get on the other side of the pump
Yeah.
and become an investor. So real estate is critical. The next level up, which to get to your question now, long
Yeah.
answer here, private credit is it's one of the areas where billionaires we are different than billionaires because very few billionaires need income, but
Right.
private credit is very unique amongst all of the private alts asset classes in that one, it's high income. And
Hmm.
if you're near retirement and you're looking for something with you want to generate income,
Yeah.
private credit is definitely where you want to go. And it's got a couple other really unicorn kind of benefits in the private alt space. One, besides high income, it's generally safer because you're down the credit stack, right?
Yeah.
You're letting everybody else take equity risk, right?
So
You're
let's,
just
do you mind, Bob, do you mind
yeah,
drilling down? I'm sorry to interrupt, but
yeah,
I
no,
think this is a really important point. Do you mind just drilling down into the credit stack? So if we have a property, obviously you have the primary lender on that property typically. You have equity investors, those LP investors, a lot of times at the top. Where does private credit fit in, and why would this even be a portion of the credit stack? What's appealing
yeah.
to an
So
operator, an
so
owner?
uh, so private credit will come in either usually they can come in as a senior lender. We've done that.
Mhm.
So we've come in as a senior lender for bridge where,
Mhm.
okay, closing date, they couldn't meet the closing date. So the seller refused to budge on the closing date but their primary lender couldn't get it done in time. So we made a 60-day loan, and we made, I don't know, crazy level of return on 60 days, got taken out. So we are the senior, but then there's another level called mezzanine, which is a second lien. It's like a HELOC or second mortgage, and a lot of times this is filling the gap. So purchasing, for example, a lot of purchases today because interest rates are lower in the past, they're doing agency assumptions. So
Yes.
you can buy an apartment complex that has a Fannie Mae or Freddie Mac debt in place. That debt may be at 3% or
Yeah.
4%, and it's assumable by the new borrower.
Yeah.
And so everyone wants to jump through that. But what happens is it comes at a lower LTV. You may only be levered 50%, which makes it a really lousy. It's a great interest rate, but it makes it a lousy investment because you need a little bit more leverage to get decent returns.
Yeah.
And so they'll come and put a little mezzanine piece in there or preferred equity, which is like this cross between debt and equity, but it really is more like it's equity, but it acts more like debt.
Yes.
And so what happens in these debt positions, if there's a liquidation, the first guy to get paid is the senior lender.
Hmm.
The next guy to go, and he gets paid every dime before anyone else gets anything.
Yep.
Then you get the mezzanine lender who gets paid every dime before anybody above them gets anything.
Yeah.
Then you got the pref equity who gets everything every dime before any of the common gets equity. So usually a common equity investor is number two, three, or four
Yeah.
person to get paid. And now that's good if everything is the moonshot worked, you're making all the profits, right? And all the lenders are just getting their little piddly, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12%, whatever their number is.
Yeah.
All they're getting, and you made the 100%,
Yeah.
but it works the other way too, right?
Right.
If the deal doesn't go good, the lenders get all their money and you get nothing. Like you could
Yes.
get wiped.
Yeah.
And we're seeing that now.
We are.
I mean, we've
That's a
done
great
some
point.
private credit deals
Yeah.
right now where the timelines are getting long, the development deals. We're going to end up making more money than the common equity
Yeah.
guys, because
Yeah.
it's just dead. It just keeps compounding.
Yes. Yeah, and then one of the things that we've also seen in this market is as interest rates have increased, we've actually seen the spread decrease between, like you said, that middle portion, that mezzanine debt or that preferred equity that's in there, and the common equity investors. So the risk has actually gone up, and the returns have come down to a
Yeah,
degree in that.
that's
So it's a
right.
real sweet spot in the market
Yeah.
where
What,
we are today.
and we haven't mentioned, but the other superpower for private credit is
Yeah,
liquidity. So the bane of private alts, and the reason a lot of people stay away from them is
yeah,
because they're not liquid, right? You
yeah,
send your money off, you may be stuck 3 to 5 years in an apartment
yeah,
complex or something, and maybe longer if the market turns against you.
yeah,
And people are afraid of that. But most private credit has liquidity provisions. In our funds, we have a big $100 million private credit fund it has 1,000 mortgages in it. 1,000. Well, we have 50 to 60 pay off every quarter. So
yeah,
you want your money back, just declare it, just declare a redemption, and we've
yeah,
never failed. Now that doesn't mean there's a scenario where we couldn't, but
yeah,
we have you never yet in 13 years of running this. And so liquidity is another big thing that makes private credit very unique. So you see it's like having a Lego set, right?
yes,
You get this this real estate that does ABC, and you got the private credit that does DEF, and you can put this together to construct exactly what you need at the risk levels you want to take.
that's terrific, and that is a big difference between the billionaires. And when the stock market goes down, they say, "Hey, this is great. We can reallocate some into that and take advantage of the reduced prices." Same thing with real estate that's happening today. And if you have a well-balanced portfolio, certain areas are going to perform. And that's one of the big things I've seen, Bob, is as I talk to investors over the past couple of years, when the stock market was tanking in 2022, investors wanted to pile money into real estate that was skyrocketing. As the stock market has now gone up, tremendously here over the past few years, investors say, "Oh, I don't want to take money out of the stock market. It's doing
Right.
great." But if you have this well-balanced portfolio, you can rebalance. And tell us about how the billionaires handle that versus just letting money ride in one asset class.
Yeah, Chris, but rebalancing is absolutely critical. So I have a bunch of data in the book that
Yes.
shows how investors are just, blockheads. We are victims of our emotional wiring. And just
Yeah.
like you said, I'll tell a funny story. I ran a hedge fund for a while as a stock market trader. My best timing indicator pinged market tops and bottoms. You know what it was? My mother. So mom
I love
mom would call and
Yeah.
say, "Bob, back up the truck, buy everything right now. It's only going up." And I'd say, "Thank you so much, Mom." I
Sell,
would
sell,
sell.
sell, sell, sell.
Yeah, yeah. And then she would say, "Get
Yeah.
out of the market, bail, bail, quick, it's all going down." And that's the
Time
time
to
I'd say,
buy.
"Thank you so much, Mom. I'd buy." And that's a funny story. It's actually a true story, but it's the problem is whatever is going on is not going to continue. And when everybody is bullish, then who is left to buy more?
That's right.
Right? No one. They've
That's right.
already bought.
Yeah. Yeah.
When everybody is bearish, who's left to sell off? No one. Everybody's
Yeah.
sold. Everybody's going to sell. So, and so what happens is the market always reverses on sentiment. And so your sentiment is your worst enemy, your mindset. And I go through all these mindsets in the book.
Yeah.
But one of the way to beat this is rebalancing. So if you had your stock market years took off, the last 2 years have been record breaking in the stock market, 25% return.
Yeah.
unheard of back-to-back years.
Yeah.
By the way, the chances of that happening again are virtually nil, but it did. Well,
Yeah.
now your stock market is good. Well, what happens is rebalance, you're going to be selling off some of that portfolio and putting it into stuff that you're underallocated in.
Yeah.
And so rebalancing makes you buy low and sell high,
Yes.
and it forces you to do it. And yeah, no one wants to do it. And it's why, so under reading books like this is real important because it gets it in your head. It's like I love reading health books and diet books because it reminds me to, not eat the crap.
And I see you
And so
got your Whoop band on. I
investment
think
books
if I saw
because
that
it helps
flashing.
me,
Yeah.
right? Remember to go against my emotional wiring.
Yes. Yeah, and that's one of my favorite indicators. It's a quarterly survey that's done by investors, and it's one of the number one correlated indicators of performance. It's inversely correlated. The higher percentage that investors allocate to stocks, the lower the future returns, and the lower
Yeah,
amount that's allocated, the higher the future returns.
exactly.
And yeah, one of my professors getting my MBA, he talked all about investor. I forget what his class was, but it was talking about the emotions of investors, and
Mhm.
that was his whole science. Bob, as we wrap up here today, I know listeners are saying, "Well, Bob, like, what do you see coming?" So we see stock market at record highs. We see gold skyrocketing. We see some potential worry in terms of the currency markets out there. What are your thoughts on that? But also, energy and AI. I want to ask you that because we see a tremendous need in the energy space with AI. So, any thoughts you can share on those two
Well,
topics briefly
you
before we
just
wrap up?
open up about 50 cans of information there. I don't know where
Well,
we
we'll
want to
have to
go.
have you back on. We'll have to do a second
Yeah.
episode, part B with Bob.
Yeah, I mean, I think just the stock market. Again, I am a true data nerd and a
Yeah,
finance nerd. And if you
yeah,
plot the valuations against 10 future returns, you can see right. I mean, it's just reverse correlation. You can see
yeah,
right where we're at, and basically the market is predicting right now, if history holds, about 0% returns in the stock market for the next 10 years.
yeah,
Now it could have another record-breaking year, but
yep,
I don't think it's going to. I mean, right now the valuations are higher than they were at the peak of the dot-com era,
that's
and
incredible.
that's what happens when you have, the internet age was truly revolutionary. So is the AI age,
Hmm.
and investors get over exuberant, and it
Yeah,
doesn't because it's a great technology doesn't mean it's a great investment, right?
yeah,
So I think the stock market is probably going to be very volatile and go nowhere. I think interest rates are going to remain higher for longer, and I've been saying that for several years. I think
yes,
inflation is going to be stickier than people want for several reasons. First is the bond market, that people don't realize we have. So the bond market interest rates are set at auction in the bond market. Long rates are.
hmm,
Short rates are set by the Fed, long rates are set at auction.
hmm,
And it's a
hmm,
supply and demand, right? So,
yeah,
but if you look at supply of treasuries at auction, it's six-fold higher than it was prior to the great financial crisis. Why? Because of all the government deficits. So supply we're selling at auction is six times more stuff to sell than has ever been sold before. What's going to happen is the prices have to rise to attract investors. Prices have to fall to attract investors, sorry, which means yields rise. And
yields rise.
so
Thank
I
you.
think we
Yeah,
have a systemic problem with this added to wage inflation. We have a worker shortage that is systemic. It's not cyclical. It is
hmm,
structural,
hmm,
and that's because of aging demographics.
yep,
And so again, we're going to see wages continue to accelerate, and wages are leading the inflation indexes. So there are a lot of reasons I see higher inflation, higher rates. I don't think, I mean, I've been in the gold market forever. I've made a lot of money in gold, but gold is, don't put, trust me, please don't put all your money in gold, right?
yeah.
And it's been a
It's
lousy
a good portion
investment
of your,
mostly.
yeah, yeah. Just
It's
a
been a
little,
lousy
yeah,
investment.
little hedge is not bad. Yeah,
Yeah, fine. And
yeah,
it's great to look at,
yeah,
but it's shouldn't be core, and it doesn't mean the world's collapsing. It just means it's having its cycle after being comatose for
yeah,
decade and a half.
yep,
So
yeah,
it's just doing its thing, right? And then it'll
yep,
disappoint everybody and crash and rob everybody of their their exuberance. So, I've been through multiple gold cycles. So I don't think it
I
means
remember. I
anything.
remember the last one because we got married in September of 2006, and the guy that was in the gold market was buying everybody drinks, and I was like, "This is before we started buying drinks at the wedding," and I was like, "What do you do?" He's like, "Oh, we run a gold fund." I was like, "Oh, interesting." So I'll never forget that last top in there. But Bob, we're going to have you back here in the next quarter. We're going to talk about what do you see in the macroeconomic cycle. But I want to be sure everybody has the link here. You can get Invest Like a Billionaire, your new book, on Amazon.com. You can also check out our credit fund. You can click on the invest link at nextlevelincome.com if you want to learn more about that and our partnership with Aspen Funds. Bob, what's the best way for listeners to find out more about Aspen Funds and stay in touch with you all?
AspenFunds.us.
Perfect. We got that in the show notes as well. Bob, always a pleasure talking to you, my friend. Thank you so much for your time and sharing your wisdom with our audience today.
Great to be here, and best to all your listeners.
Wonderful. Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.